Hi, my name is Elijah Rochon, and this is my Accounting 2140 Go See It project. The company that I'm going to be presenting on today is Vans. Vans was founded in 1966 by Paul Van Doren. Its headquarters is based out of Anaheim, California, and Vans produces skateboarding shoes, clothing, and accessories, which are sold online through their website and retail stores throughout the country. In 2005, Vans was acquired by VF Corporation, and they turned their existing number of retail stores, which was 170, into 340. One of the most important changes that was brought about when VF acquired Vans was that they were able to successfully increase revenue each year at every individual store, as well as decreasing the cost of making, selling, and transporting those goods. Vans manufactures and sells a wide variety of clothes and shoes, and some of the varieties of their shoes range from the classic lace-up mid-top to the iconic slip-on, and even to the high top. The reason that I chose Vans is I was actually an employee there up until the coronavirus pandemic began. That I actually worked in the stockroom with a lot of the inventory and a lot of the merchandise, so I got to see how it all works when we are receiving new shipments and shipping things out to other stores. Because of the fact that Vans is such a large corporation, they need to use different accounting principles in order to make sure that the production, shipping, handling, and sales of all of their products go smoothly. For Vans inventory evaluation, they use the FIFO methods, first in, first out. For our more popular and generic items, Vans uses the FIFO method, first in, first out, when replacing the inventory that they already had after there have been sales made. The remaining inventory is then sent out from all of Vans retail stores to many of the outlet stores. At these outlet stores, the shoes and clothing are then sold at a discounted price. This discounted price is still going to be higher than the original acquisition value, meaning that their fair market value is greater than what it costs to produce the shoes in the first place. Because Vans produces, transports, and sells the shoes all by themselves, they are able to keep shipping costs low. Inventory both at the Vans warehouses in Anaheim as well as all of the 340 retail stores throughout the country is all accounted for digitally. That way, each time the store gets a shipment, it is able to be scanned in and then is automatically updated into an online database. It's helpful because it allows Vans stores throughout the country to communicate, to see which shoes and which sizes are at which store, and to see how they can get those shoes from one store into the customer's hands. 2019 alone, Vans net income was somewhere around 13.45 billion US dollars. Let's look at the Era, for example. This shoe would retail at a Vans store for about $75. In reality, the production cost is only $31.20. That is over a 240% profit increase. Once a quarter, in order to account for lost, stolen, or missing merchandise, Vans is required to use the manual inventory method, where they go through the stockrooms and look at each and every single pair of shoes on the shelves, and they then scan them individually to look and see what the stock is at the end of that quarter. In Vans financial statements, inventory is listed under assets as merchandise inventory. This is what they are able to use in order to account for any changes over the fiscal year. Now that you've heard a little bit into the history of Vans, I hope that you're able to see how one of the reasons that the company is currently going so strong is because they're able to keep their costs of creating merchandise low and their selling costs high, which increases their profit margin at the end of the year and leads for increased store numbers as well as sales.